So Dave Ramsey says that whole life insurance is a horrible place to put your money. In fact, he says it's the absolute worst place that you can keep your money. He has 3 attacks, I guess I'll call them, that he likes to use as his top 3 reasons that whole life is an absolute horrible place. And in this video, what I'm gonna do is I'm gonna go through those 3 reasons and I'm gonna completely debunk why he is wrong, either wrong, misleading, or just straight up lying to you about these elements of whole life insurance. I'm not saying whole life insurance is perfect for everybody. I'm not saying it's the right fit for every situation. But the way that Dave Ramsey misleads and lies about whole life insurance publicly and unabashedly on the airwaves just is one of the most frustrating parts that I see in the personal finance space. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video, because I got videos like this coming out every single day. Let's get into it. Hey, what's going on, Cashflow hackers? It's Chris, and we are getting back here with another Dave Ramsey video because, listen, this is just one of those things. People keep coming to me and they keep asking me things. And, I always kind of tell people one of the things that inspires the content that I make is comments and conversations that I have with people, whether it's in the YouTube comment section for people who make comments. I read them diligently. I am very, very in touch. I do not hand off my comment responses to a virtual assistant or anybody else on the team. I take ultimate responsibility, and I think that is the lifeblood of what we do. And so I think knowing what everybody's thinking is a really important part of my job as the person who's creating this content. And so I'm not going to outsource that to somebody. So that said, I've been getting a lot of comments about, Dave, people asking questions about Dave Ramsey and his perspective. And there are 3 things that come up that I see in his videos, and 3 things that people seem to ask the question of every single time. And quite frankly, I'm filming this video for very selfish purposes, so I can actually have a video that I just send out when people go, hey, what about this? I can just send it to them, because these are things that happen every day. Like, I literally have to answer one of these questions every single day and explain it. So let's just do it. What I'm gonna do is I'm gonna hop over to my board here. I'm gonna share this, and I wanna talk about this. So, and you can see, here are the 3 questions. Dave Ramsey says the number 1 reason that you don't wanna get life insurance is because the life insurance company keeps your cash value. You don't get the cash value and the death benefit. Now, it's not that he's lying on this, but if you design a policy properly, that is not going to be an issue. Let me show you. All right, so this is a whole life policy design right here. And so what this is showing you, and let me get here, and I'll get my marker going here so I can draw up on this. So what this is showing is that, a 36-year-old, year 1, putting in $110,000 year 1. So this is assuming that they had some saving in another account, but the principal doesn't change, $110,000 and then $10,000 a year. So there's a couple things I want to show you. Dave Ramsey said whole life is a horrible place to keep your money. Well, I could either have $110,000 in a savings account, or I could take that money and I could put that money into a whole life policy. And that whole life policy, I'm not going to have $110,000. I'm going to have $101,803 is going to be my cash value. Now, I have access to that money. And here's the deal. I also pick up $1,781,000 of cash. Now, here's the deal. Next year, I put in $10,000 right here. My account value grows by $10,953. It's growing by more than I'm contributing already starting in year 2. So when he says, though, so the point to answer, I just wanted to get that kind of understanding to kind of show you how liquid these can be. It's completely opposite of what he says, where he says you have no money accessible for the first couple of years and it takes forever just to break even. Well, in this, you can see that that's not the case. But furthermore, look at the death benefit. When we first start off, what do we have? We have $1,781,592, and we have a cash value of $101,803. So you could see year 1. Let me go here. I'm going to go 8, 12, 9, 8, 0, 15, 7. I should be able to do this better than this, huh? 10, 9, 7, 6. $1,679,000 is your actual death benefit, okay? And that is because of the fact you bring out the cash value. As the cash value increases, the death benefit, if you design a policy properly, the death benefit is going to increase, okay? So here's the thing. Why is it increasing? It's increasing because we're utilizing a blend of paid up additions. That adds more value into the cash value, and it also makes the death benefit go up in accordance. So here's the deal. Let's look at this. The next year, the cash value grows to 112,000. So the argument here is like, we don't want to use this because the life insurance company keeps your cash value. They would say, you don't get this, you only get the death benefit. Well, look at this. The cash value went up by just about $11,000. But look at the death benefit. The death benefit went up by $16,000. So the death benefit went up by more on that situation when you look at these two things. So when he says the life insurance company is going to keep the cash value and you only get the death benefit, do you really care? Because at the end of the day, the real death benefit that you pay if you design these right and you design them the right way, you're really only paying for this $1,679,000. And then you do paid up additions to make it work and you design it right, that will get the death benefit increasing the entire time. Now, full transparency, when you design a policy the right way, and I know I'm going to get questions on this, so I'll just answer it, is you can see that the death benefit here drops off. The reason for that is because we're utilizing a term insurance policy, something Dave Ramsey is a big fan of. We're using a term insurance policy to optimize this. At 15 years, the term insurance drops off because you could see it's basically $1.3 million of term, and the rest of the insurance it drops down. And now the rest of this insurance that's left, that 709, is permanent cash value insurance. Once again, though, the principle doesn't change because now the good news is, whereas if all you had was term at that point in time and it expired, you would have nothing if you were saving this $325,000 in a bank account, which, by the way, at that point in time, you've contributed $250,000. You have $325,000 liquid. If you were saving in a bank account, you wouldn't have this much. You have more money at year 15 in a whole life policy than you would have had in a bank account. Plus now, when your term insurance expires, you still have permanent insurance. So the fact that he has the gall to insult this product in such an uneducated way or misleading way or deceitful way, I'm not sure which of the three he's actually coming at it from, but the fact that he does that, to me, is just like financial malpractice, and it's such poor education. People don't understand it. So, but you can see here that we got 740 is the cash value, right? And then the next year we got 370, right? So that is let's just call it $23,000. That the increase, it goes up 23K. Well, guess what? The death benefit here goes up 27K, right? So the principle keeps going the same way no matter what. Like, as the cash value increases, the life insurance death benefit also increases all the way down through. Now, what does that mean? Why do we do that? And you can see that the death benefit is going to keep growing. So why is it the life insurance companies do this? Well, I'm going to erase this so I can operate a little bit more cleanly here. And the reason they do this is because if you were to save, let's just say this money, they could do it and they could say, listen, we're going to pay you $347,000 if you die that year. We're going to give you $347,000 in cash. And then we're going to take the difference, which would be what? 3, 4, 5, 6. Let's just call it, 316,000. So we'll just say, just for the sake, I'm sure the math is not right, but let's just say 316K death benefit. So they could say, we're going to pay you the 347 cash value, and then we're going to give you the 316 death benefit, and we'll give you both because that's ultimately what you have. We could do that. But if we do that, just like a bank account, we're going to have to tax this 347. So by doing it this way and having both of the policies grow at the same time, the good news is this 347 you don't have to worry about. They say, no, we're not going to pay this to you. We're just going to get rid of this, and we're going to pay it all to you in one thing. That way it's tax free. All of it, not just a part of it, right? If you save money in a savings account and you had a term policy, the death benefit on the term policy would be tax-free, right? Of the 1.7 million, but let's say you had 325 in a savings account, that would be completely taxable, right? So it's important to understand that that's how this works. And so, in fact, when Dave positions this as being something that's completely horrible and a reason that you shouldn't do this because these evil insurance companies are doing this to you. It's actually one of the greatest benefits of the policy. And so the misleading nature of that, or the uneducated nature of it, and the fact that he stands on such a pillar of conviction about something he either doesn't understand or is being completely deceptive about, I think is really important for people to understand. Okay, so that brings me to my next thing, where he says your returns in a life insurance policy are just a return of premium. And so if you're doing that, and really ultimately what you're doing, if it's a return of premium, is where you get the dividends. That's the dividends are just a return of premium. If that's the case, then it's a ripoff, because that means you're paying too much, you're overpaying for the insurance, and then they're paying you back those that overpayment in the form of dividends, and that's all you get. At the end of the day, that's not really how this works. The dividends come from a return of premium for all products across the board. And if you know anything about mutually held life insurance companies, that includes annuity premium. It includes the performance of the general fund of the account on their investments. It includes term insurance premium. You get a return of some of that after all the mortality charges that they get. You are a business partner with the life insurance company. As a policyholder of a mutually held whole life insurance policy with a participating mutual company, you are effectively a shareholder of that company participating in the profits. Now, it just so happens that the profits come from premium sales after mortality charges and expenses. That's a life insurance company. That's what it's all about. That gets paid to the participating mutually held policyholders in the form of a dividend. He says that it's just a return of premium, and therefore it's a ripoff. Now, if that were the case, think about it this way. Use common sense here. I want to encourage everybody to use a little common sense. If it were just a return of premium, that means I would never be able to have my cash value really get ahead of my total premium. Does that make sense? Because if I paid in $10,000 and they overcharged me, and they were just paying me back a portion of my premium that I overpaid for, it would be mathematically, statistically impossible for me to ever accumulate more money than I've contributed to that policy. Does that make sense? Let's take a look at this policy again and see what I'm talking about, because this is so important to understand. It's another misleading area. So you can see here, we have a couple columns here. We have a cumulative premium column right here. This cumulative premium column is important to understand because this is a total amount of money that you put in. You got 110,000 year one, 120 total because it's the 110 plus the 10 equals that 120, right? So you could see here the net cash value is 101,803. Well, you could see year two, you put in $10,000 that year, and that policy is already growing by 10,953. They say it's a return of premium. Well, you put in 10,000 as your premium. They're returning you more than your total premium altogether here already. So let's take a look at this. By year 6 in this policy, you could save this 160 cumulative premium, cumulative savings in a bank, or you could pay in this 160 life insurance policy, and you're going to have more total money after all your insurance charges, after everything. You're going to have more total money sitting in your account, accessible for you, and you're going to pick up $1.8 million of life insurance. And this doesn't even count the fact that you have living benefits that we haven't talked about, right? If you become chronically or terminally diagnosed with anything, with this policy, you have access to a portion of the death benefit while you're alive to pay for like medical care, for like long-term care, for disability, anything of that nature. Now, a lot of people haven't prepared properly. They haven't bought the right long-term care coverage. It's maybe not available, or it's too expensive. Maybe they don't have disability. By doing it this way, you know, what Dave says is true when it comes to term insurance, and a lot of people don't need all the big insurance, but I promise you, even when, you know, you hit 55 and your needs for life insurance are maybe not the same because your kids are grown and gone, I guarantee you that having access to this $820,000, let's say 820 minus 446 is, 4, 5, 6, 7. Let's call it 380K is the death benefit portion, because you got the cash value there, as we've already explained in the last section. Having access to this $380,000 of life insurance that you can accelerate for living benefits for LDs, right? This is huge. He never talks about that. You can't do this with term insurance on a long-term basis. You can only do this with whole life insurance. So think about all the different ways that it's going to benefit you. Now, once again, getting back to the point, he says it's only a return of premium. If it were a return of premium, you could never statistically, possibly, mathematically, ever have it be that you would have $160,000 of premium paid right here and more money, because if it were a return of premium, you couldn't have more than you've actually contributed, because the company's got to keep something. So if that $10,000 is all premium, obviously a lot of that money is going to work for you in ways that Dave is not acknowledging, right? And so that's a big thing to understand. And so when we get down here to year 20, I just want to show this to you. You've contributed $292,000. You have $446,000. So this is a wildly efficient contract when you look at this. When you compare this to a savings account and you look at the liquidity that this has compared to a savings account, which is very comparable, and you look at the growth that this has compared to a savings account, and then you look at the other benefits like the living benefits and the death benefits that come along with it at every stage, you can see the death benefit keeps growing. This becomes a big no-brainer, and it's one of the reasons that I always kind of tell people, Dave Ramsey, a lot of people like to give him the benefit of the doubt, and I have a hard time doing that because I don't understand. He either hasn't taken the time to get to know this, and because so he's just stuck on his way of thinking. And if that's the case, to me it's malpractice, because he's got a responsibility with his following, with his position in the market, to actually educate himself and to pass on good information. The information that he passes on about whole life insurance is not good at all. And so that's that one. Now, what do we got now? We got whole life insurance is a horrible investment. All right, let's just continue this conversation. Whole life insurance is not a horrible investment because it's not an investment at all. An investment entails risk, okay? So one of the things that I think is important to understand is investments have risk. And these companies, A, have guarantees, and B, have never missed a dividend payment. Like this company that I'm looking at right here has never missed a dividend payment in 120 years. So when we look at this, the current assumptions, it says non-guaranteed. So I want to explain this because we have a guaranteed column. The guarantee on this is 2%. Okay, so it's not great after all costs of insurance and all that stuff. A lot of people would look at this and be like, all right, I've contributed this $292, I only have $239,000. So that's not very good on the guaranteed side, but this is assuming that the company never pays a dividend, not once in that 20-year period. The problem is in 120 years, they've always, and when I say problem, the problem for Dave, they've always paid a div, right? So therefore, we don't have to really worry about that. Like, I mean, even if they miss one for some reason in the next 20 years, they're going to pay a dividend. And so the good news is I can look at this and I can say, wow, right now the dividend with this company, specifically, just to use numbers, is 5.2%. Now, that's not a net number. That's a gross number. You're going to have to back out all the insurance charges and all that stuff. But even so, it's going to outperform your bank account. And these are not guaranteed, but they're assuming the current, it's based on the current dividend scale of 5.2. Now we're at all-time low levels of the dividend scale for these companies in 120 years because of the low interest rate environment. As the interest rate environment increases, these numbers should go up. And so if the dividend rate goes up, this policy will perform better. If the dividend rate goes down, this policy will perform a little bit worse, but it's definitely got a lot more upside in a whole life policy at this point in time than it does downside because of the guarantees, because of everything that we're looking at, because of the fact that they have a 120-year history. So when people go, why do you always focus on the non-guaranteed assumptions? It's because these assumptions are based on super conservative values. Now, 20 years ago, when we were at a higher interest rate environment, or 30 years ago, I should say, when we were at a higher interest rate environment and interest rates were like 8%, and dividends were paying out in like the 7.5% to 8% range, right? If that were the case, well, yeah, it was worse because dividends were coming down. And so these were being illustrated at those 7.5% to 8% rates. And therefore, when dividend rates went down to 5.2, it performed worse and worse and worse over time. Now, the dividend was still paid out, but it wouldn't have performed as well as it was showing. Well, this is, once again, the game has changed. When Dave Ramsey first started, this was, ripping on whole life insurance. This was kind of the environment that he was in. And if you didn't understand it, it didn't make it bad, by the way, the fact that it underperformed what it was showing, it was still really good compared to a bank account. But if you compare it to an investment, it's horrible. And unfortunately, yes, there are a lot of bad actors out there in the whole life business that are selling it as an investment. But for you, it's important not to look at this as an investment, but to look at it as a banking alternative. You use this for your emergency fund, you use this for your opportunity fund, and you use this as a way to improve your financial life. And for this one asset, it gets each dollar that you put into it performs multiple duties. It's got your savings account. It's got an opportunity fund if you want to do real estate investing, if you want a capital reserve fund for a business, if you want to have long-term care protection in a way, if you want to have the living benefits, if you want to have an alternative for your medical directive, right? Like I'm a big believer in alternative treatments for things like cancer, stuff that insurance won't cover. This kind of policy will do that. If you follow Dave's strategy, you're not going to have access to that, right? So these are the three biggest things that he always says that I felt just compelled to be able to talk about and show people what's what on this, because they're not only the three biggest things that I see all the time, they're the three areas that I believe he categorically just misrepresents the spirit and the nature of what whole life insurance actually is, but he does so in a way to fit his paradigm, to scare people, to force a scarcity mindset down people's throats, and ultimately it gets people thinking about it improperly to a perspective where they make poor decisions. And so anyway, hopefully you found value in this video. If you did, and if you have any questions, any comments, leave them in the comment section below. I do my best to engage with every single one. If there's other things that Dave Ramsey is saying that you are confused about and you want me to make a video on it, just put them down below. I'll make a video just like I'm doing this one. Hopefully, once again, you found value in this. If you did, subscribe, hit the bell, that way you're notified every time I launch a new video. Till next time, have a blessed, inspirational day. We'll talk soon.